Most traders don't lose money because their analysis is wrong. They lose money because they enter too late. They buy after the rally is already exhausted, or they sell after the market has already started bouncing. But the market always gives early warning signs before a trend changes. If you know what to look for, you don't need to predict tops or bottoms. You simply recognize when momentum is dying. In today's video, I'm going to show you some of the most reliable reversal patterns in candlestick trading. The morning star, the evening star, and the most powerful versions of all, the morning and evening doji stars. These are not random candle shapes. They represent real shifts in control between buyers and sellers. If you understand the psychology behind them, you'll never look at charts the same way again. So make sure you watch till the end, because the doji star patterns I'll explain later are rare, advanced, and extremely powerful. Let's start with the foundation. A group of reversal patterns known as star patterns appear when a strong trend begins to lose strength. A star is a candle with a small real body. It can be green or red, it doesn't matter. What matters is that this small real body does not overlap the real body of the previous candle. The star's real body can appear inside the shadow of the prior candle, and that's completely fine. The only requirement is that the real bodies do not touch. When this star forms as a doji, meaning the open and close are almost the same, it's called a doji star. Why is this important? Because a star represents indecision. In a strong uptrend, buyers are in full control. But when a star appears, buyers lose aggression and sellers begin to push back. The market shifts from control to balance, and balance is dangerous for a trend. The same logic applies in a downtrend. When bears lose momentum and a star appears, selling pressure is cooling. This is why star patterns often form near market turning points. Now let's move to the first major pattern, the morning star. The morning star is a bullish reversal pattern that forms after a decline. Its name comes from astronomy. The morning star appears just before sunrise, signaling that darkness is ending. In the same way, this pattern warns that a downtrend may be coming to an end and higher prices could follow. The morning star is made up of 3 candles. The first candle is a long red candle. This visually confirms that bears are fully in control. Price is falling with strength, and sellers are dominating the market. The second candle is the star. It has a small real body and does not touch the real body of the first candle. This candle shows hesitation. Sellers are still present, but they are losing momentum. They can no longer push price down aggressively. The third candle is the confirmation candle. It is a strong green candle that closes deep into the body of the first red candle. This tells us that bulls have stepped in with force and taken control from the bears. This 3-candle sequence shows a clear shift in psychology, from strong selling to indecision to strong buying. One very important concept here is support. The lowest low of the 3 candles forming the morning star often becomes an important support level. When price pulls back later, this area frequently acts as a floor. Now, in an ideal textbook example, there would be a visible gap between the second and third candles. But in real markets, especially in stocks and crypto, gaps are rare. From experience, the lack of a gap does not weaken the pattern. What really matters is this. The second candle must show indecision, and the third candle must show conviction. Let's understand this with a chart example. In this chart, price was clearly in a downtrend. Then we see a long red candle, followed by a small candle, and then a tall green candle. This satisfies all the conditions of a morning star. One thing you may notice is that the third candle overlaps the second candle. Many beginners think this invalidates the pattern, but it doesn't. In fact, the second and third candles together formed a bullish engulfing pattern, which actually strengthens the bullish signal. This is a critical lesson. Candlestick patterns are not about perfection, they're about context. Now, there is one limitation with the morning star. Because it's a 3-candle pattern, confirmation only comes after the third candle closes. By then, price may have already bounced sharply. If you enter immediately, your risk can be large. A smarter approach is to wait for a pullback toward the support zone created by the morning star. This gives you a tighter stop below the low of the pattern and a better risk-to-reward setup. If this explanation is helping you understand price action better, hit the like button. It really helps the channel grow. Now let's flip the script. The evening star is the bearish counterpart of the morning star. It forms after an uptrend and warns that bullish momentum is fading. Just like the evening star appears before darkness, this pattern signals that a move higher may be coming to an end. The evening star also consists of 3 candles. The first candle is a long green candle, showing strong buying pressure and bullish control. The second candle is the star. This is the warning sign. Momentum slows, and the market enters a state of indecision. The third candle is a strong red candle that closes deep into the body of the first green candle. This confirms that bears have taken control. Ideally, there would be gaps between the candles, but again, this is rare. What truly matters is how aggressively the third candle pushes into the first candle's body. Another key concept is resistance. The high of the evening star often becomes a resistance level. When price rallies later, this area frequently stops the move. Let's look at a chart example. In this chart, an evening star formed after a strong uptrend. The real bodies did not overlap, which made the structure very clean. After the pattern completed, price dropped sharply. Later, price attempted to rally back toward the resistance created by the evening star. It stalled. A doji formed near that level, signaling exhaustion. On the next attempt, price failed again and formed a bearish engulfing pattern, leading to another strong decline. This example highlights a crucial rule. Trend defines the pattern. A bearish engulfing pattern is only meaningful as a top reversal if it appears after a rally. Context is everything. Just like the morning star, the evening star can sometimes give a late signal. If the stop loss is too far, waiting for a bounce toward resistance can dramatically improve your risk to reward. Before we move to the advanced patterns, comment below if you trade candlestick patterns or if this is your first time learning price action. Now let's talk about the most powerful versions of these patterns. When the middle candle of a morning or evening star is a doji, the signal becomes much stronger. A morning doji star forms after a decline and can signal a meaningful bottom. An evening doji star forms after a rally and warns of a potential top. A doji represents extreme indecision. Neither buyers nor sellers are in control. In rare cases, if the doji gaps on both sides and its shadows do not touch the surrounding candles, the pattern becomes an abandoned baby. These patterns are extremely rare, but when they appear, they often lead to sharp reversals. Let's look at a morning doji star example. In this chart, the middle candle is a doji with long upper and lower shadows, showing intense indecision. The third candle overlaps the doji slightly, but that doesn't weaken the signal. Price rallies strongly afterward. Later, when price pulls back, the low of the morning doji star acts as support. This confirms that the pattern marked an important turning point. Now an evening doji star example. Here, the third red candle didn't close deeply into the first green candle, but the pattern formed near a key resistance level. Price failed to break above this level in the following sessions, validating the pattern. Later, a strong bearish engulfing candle delivered the final confirmation, and price moved lower. To wrap this up, remember this. Star patterns don't predict the future. They reveal when control is shifting. When you combine them with trend, support, resistance, and patience, they become powerful tools for spotting reversals early, before the crowd reacts. If you found this video helpful, hit the like button, share it with a trader friend, and subscribe to the channel for more price action-based trading content. Let me know in the comments which candlestick pattern you want me to break down next, and I'll see you in the next video.